So Dr. Brett and Brian, they were pretty good. But this cucumber water, I gotta tell you, is delicious. Highly recommend it. So, they call me over here like, JC, want you to present, kind of do your thing. So like for me, I'm not gonna go into this whole education thing and teach you guys how to do anything really. I'm really just gonna walk you through my process and show you what I do. And I'm gonna refer you to, maybe I'm not gonna refer you anywhere. So I have like some lines here, these Fibonacci extension lines. Rather than me explain to you the math calculation behind how I put them there, you can go to allstarcharts.com/Fibonacci and I lay it all out. And then the way that I use momentum as well, allstarcharts.com/momentum, and I kind of lay it all out there. So I'm just gonna roll through and we're gonna look at the charts. Some of you guys have known me for a while. They used to call me a perma bull. I don't know. I guess people who haven't known me that long, because I really don't care whether the market doubles or goes to zero. I really couldn't care less at all. I just want to be on the right side of the trend. So Dr. Brett said a lot of things. I think a nice common theme here, Brian stressed it as well, is keeping an open mind. Because the one thing we know is that we don't have no idea what's going to happen next. The good news is that nobody else does either, right? So it's a level playing field, I think. And another thing that Dr. Brett said that kind of stuck with me, I was really thrilled because I actually do that, so it's like, nice, one for the good guys, is thinking about the future and what the market environment is going to look like in the off chance that you get it right? What are we going to see that's going to confirm that we're in the right direction? And kind of picture that, write it down, all of these things. And then what is the market going to look like if we're wrong, right? Because that does happen too. So what are the types of clues that would suggest that we're on the wrong side of the trend? So we always want to assume that we're wrong and let the market prove us right? Any idiot can buy a stock that goes up. The difference between the winners and the losers are what do you do with those stocks that go against you, right? So it's all about risk management, in my opinion. So I've been bullish. There's been no reason to be bearish for a couple of years. All the signs continue to point to risk appetite, risk appetite, risk appetite, including through the second quarter and into the third quarter. But along the way, it was like, okay, we're buying stocks, the best of the best, right? The best stocks in the strongest sectors, and that had been working very, very well. Technology, medical equipment stocks, some of the healthcare stuff, things like Berkshire Hathaway, semiconductors, all working, right? The best of the best, just shut up and buy them, right? Along the way, however, it was like, all right, we're going to keep that strategy as long as we are holding above this level in this index, this index, this index. If we're below those levels, all bets are off, right? So along the way, we always held those levels, so we stuck with our plan, right? Buy the best of the best. That changed at the beginning of October. Laid it all out at the end of September, be like, listen, if the Russell 2000 on the IWM breaks 169, can't be bullish. S&Ps break back below the January lows, can't be bullish. Dow breaks back below the January lows, can't be bullish. Brian Shannon, a long time ago, taught me that from failed moves come fast moves in the opposite direction, right? That's the way the market is, and that's exactly what we got. We got a rally above the January highs that could not hold. So what does that mean? That means, in my opinion, that there is overhead supply. So the thesis up here before this happened was that, okay, the market has absorbed all of the overhead supply that was clearly apparent in January. So if your bet is that the demand has absorbed that overhead supply and we're going higher, we have to hold above those levels for that statement to remain true. If we do not hold, then what's true is that there's still an overwhelming amount of supply relative to demand, and that's exactly what we have. So moving forward, that's where the dead bodies are buried. So any strength into that area is most likely going to be met with sellers. They're there waiting to sell to you. These are the bag holders, they're the dead bodies, whatever you want to call them, but they're above head as opposed to the opposite that we've been accustomed to over the last couple of years where the demand was beneath us. So sell-offs used to get bought up because we were above where demand overwhelms supply. Now it's the opposite. Now we're below where supply overwhelms demand. So if we're not above 28.75, which are the January highs, I think it's extremely irresponsible from any sort of intermediate term perspective to be buying stocks. To the contrary, I think we need to be selling into strength. And I think that we are in a an environment where there is an unlimited amount of downside risk. I think 87 is on the table. I think a severe 20-25% decline is absolutely on the table. I'm not necessarily saying that's going to happen, because if you bet on market crashes, it's an easy way to go broke. They don't really happen very often. But the fact that until now, that was not on the table and now it is, I think, reason enough to be cautious. I think best case scenario, we grind sideways for a couple of quarters and then ultimately break out. I think that's the best case scenario. Realistically, I think we're in for a lot of trouble. It's not just happening at a random level. I take these Fibonacci extensions from the most important pivot points in history. There's the 2000 highs. There's the 2007 highs in the Dow. And both of these Fibonacci extension levels exactly at the same point in this double top in the Dow. So it's not like this random area where the market's selling off. In fact, we're getting this correction at a very logical area. So here's a closer look. Looks like the S&P, right? From failed moves come fast moves in the opposite direction. I think we're lucky if we get the early 2018 lows to hold. I think that's the best case scenario for the perma bull passive crowd, is that those levels hold. It's not something I'm willing to bet on. We're not just getting these failed breakouts in the Dow and the S&P 500, but we're getting in the Dow Jones Transportation Average, which often gets lost in the shuffle of the Dow Transports. If we're not above 11,100 in the Dow Transports, can't be long. So here, kind of little Dow theory. For me, I'm not one of these guys, oh my God, one made a high, the other one didn't, sell it, blah, blah, blah. I'm not one of those. For me, it's just kind of common sense. They're both below overhead supply. So in my opinion, I think it's irresponsible from a portfolio management standpoint, from any sort of intermediate term time horizon. Again, if you're Brian Shannon or Bellafiore, you're trading these counter trend moves, doesn't matter. But from any sort of intermediate term time horizon, if you're looking at weeks, months at a time, I think there's an overwhelming amount of overhead supply that is going to take, at the very least, time to absorb, and at the very worst, severe correction. The reason I bring up the possibility of a crash is that the ingredients for a crash are already showing up, right? Here's the 2007 highs. What did we get in the Dow? Failed breakout. The rest is history. Financial crisis. NASDAQ 100 in 2000. Failed breakout. Tech bubble burst. S&P 598, long-term capital management, from failed moves, fast moves. Dow Transports, 1969, same thing, got absolutely crushed. These look way too similar to these for me to be bullish at all. Clearly, I'm not a perma bull, right? I keep an open mind, I call it like I see it, and I think there's an overwhelming amount of overhead supply and unlimited downside risk. So while the risk reward has been skewed in favor of the bulls until just recently, now the risk reward, in my opinion, is in favor of the bears. The thesis essentially, let's say a month ago, we would have had this conversation a month ago. The question that I was posing was like, all right, I don't know why this isn't working. The question I was posing was, is the underperformance that we're seeing in emerging markets around the world, financials and home builders, a heads up that shit's about to hit the fan, right? If fast forward a year, are we going to look back at the first couple of quarters of this year and be like, that was the signal? Or are we going to get rotation back into banks, homies, emerging markets, and everything's still hunky-dory and we continue to rip to new highs, right? That's the question. I was in the camp that it was probably going to be the latter, because that had been working until now, right? We would get that rotation, everything would come back, something else would, staples would sell off, financials come back, tech comes back, everything's fine. As it turns out, it was the former, right? The heads up, homies underperforming, financials underperforming, regionals underperforming, emerging markets slaughtered, all of these things, as it turns out, was the indicator that a intermediate term top was in place. Before industrials and S&Ps broke out to new highs last month, or the month before that, recently, small caps, mid caps, Microcaps had already broken out. They were the leaders, right? They had already taken out the January highs in like May or June, if I'm not mistaken. Actually, we have the data. Something like that, in May or June. They were the leading indicators. So we want to follow the leaders. And then what was the first index to break down? Small caps. Laid it out. Small caps can't hold 169. That's a big freaking problem. And we want to anticipate that before it happens, right? This isn't like Monday morning quarterback, right? This is, we're thinking about what the environment is going to look like if we're wrong, right? And the environment would look like Russell would be below 169. And then sure enough, we got clobbered. I think best case scenario, we hold 151. I doubt it. It's not a bet I'm making. We break 151. I think everything gets triggered. We got another 20 points in the Russell 2000, which represents, I don't know, you math majors out there, I don't know, another 8, 10%. I think that's probably the higher probability outcome, and we retest these 2015 highs, right? So the short is if we're below 151. If we're above 151, then the time case is stronger. We're going to resolve this mess through time as opposed to through price. So 151 in the Russells. To me, if we're above that, then crashes are off the table. But a crash is going to come with Russell below 151. When I want to know what the market's doing, I want to know what the crazies are doing. What are the crazy people doing? The crazy people are not buying S&Ps. They're buying small caps, Russell 2000. If the crazies want to be in precious metals, they're not buying gold, they're buying silver, right? So if you want to know what the crazies are doing, I like a ratio of the Russell 2000 versus silver, right? This is the better stocks versus gold answer as far as I'm concerned. And where are we pulling back from? Same levels we pulled back from 15, 16 years ago. Again, this mess that we've found ourselves in is not coming at a random place. It's coming from very logical places, in fact. So what I like to do is I like to look at the leading stocks. So if you take the Dow Jones Industrial Average, there's 30 stocks, price weighted. If you take the 5 largest components, UNH, Goldman Sachs, 3M, Home Depot, and Boeing, it represents 1/3 of the entire index. So if you want to know what the market is doing, these are probably 5 stocks you should follow. So what I did was I equally weighed them, these 5 stocks, and as it turns out, it looks exactly like the S&P 500. Again, a little oopsie, right? We've seen the common theme. Here what I did was I took the largest 40 stock markets in the world, emerging markets and developed, and equally weighted them. So this is, whoops. There you go. I equally weighted them, and this is all 40 of those. And then here's the S&P 500. So the stock market hasn't been going up because of something going on in DC or not going on in DC or New York. US stocks have been going up because stocks all over the world have been going up, right? There's no argument there. People will like, oh my God, the market's down because of taxes. No, you idiot. The market's down because stocks around the world are down. So they move together. However, with the S&P making new highs, global equities are nowhere near there. In fact, they're now breaking down. So we're getting, as it turns out, it wasn't that we're going to get rotation into the other areas. It was the US was the last man standing, and it was the last safe haven, and now everything's falling apart. I get it, we have a lot of clients, a lot of hedge fund managers that don't care about growth and value, but we have a lot of financial advisors that are clients of ours as well. They're always asking me, JC, growth or value, growth or value? To me, I don't think there's enough evidence to suggest that value is now going to lead. It looks like just like a hot mess. So we want to continue to see this. So I don't think I have a strong conviction opinion on whether it's going to be growth or value moving forward. Technically, we still have to err on the growth side until this breaks. If this breaks, then we can talk about value leading moving forward. So I encourage you, go to allstarcharts.com/momentum, and I'll lay out exactly, I'm an open book. I'm not one of these guys that hides secrets. Oh my God, my secret formula that's going to make you $1 million, download this ebook, right? That's not me. For me, I lay it all out. I'm an open book. There's no secrets. I'm fully transparent because I know you're not going to do it, right? Bottom line. So I rip through 5,000 charts a week. You might do that once, but we do it every week, and we've been doing it for years. So I'll give it all away for free. You're not going to do it. So one of the ways I look at momentum is that I try to figure out what sort of regime we're in. Are we in a bullish regime or a bearish regime? When stocks are in an uptrend, momentum's going to get overbought. People are like, oh, JC, I can't buy it. It's overbought. How can an overwhelming amount of buyers possibly be a bad thing, right, is how I look at it. So stocks in uptrends are supposed to get overbought. The key is that when they correct, because nothing goes straight up, obviously, is that they never get oversold, right? So this is, I use a 14-period RSI, 70 overbought, 30 oversold. In uptrends, we get overbought. In corrections, we don't get oversold. We hold above 35, 40. If a stock's in an uptrend, you think it's in an uptrend, and all of a sudden you see oversold conditions, you probably want to reevaluate that thesis. In all likelihood, it's not in an uptrend. It's either a downtrend or sideways. If you're in a downtrend, financials 2008, financials today for that matter, when markets make new lows, momentum's going to get oversold. on those counter trend rallies, no matter how vicious they are, because they always are in downtrends, this week was a prime example, you're not going to get overbought readings. If you think something's in a downtrend and you start getting overbought readings, you probably want to reevaluate that thesis. So we're going to take that theory, take it one step further, and what we're going to do is we're going to measure. Russell 3000 represents approximately 98% of all investable assets in the US equities market. It is the market, right? So we're going to take that 33,000 stocks, large caps, mid caps, small caps, and we're going to find out what percentage of them are reaching oversold conditions. What percentage of them are showing bearish momentum characteristics? So here's a great example, 2016 lows. Last time I was super bearish. It's good times. We made a low in January. We had a huge spike in stocks in the Russell 3000 getting oversold, essentially showing bearish momentum characteristics, which is perfectly normal when they're in a downtrend. However, on the next low in March, we had much fewer names getting oversold. Essentially, so while the indexes were putting in new lows, the 26-year-old journalist who's never traded a stock in her life is forced to put the headline out there, S&P makes new lows because of whatever, explosion in Syria, whatever happened that night, right? But what you won't hear is we made new lows, but fewer stocks are showing bearish momentum characteristics. We are seeing improvement underneath the surface. So when people ask me, well, JC, okay, now you're all gloom and doom, what do you need to see that would suggest that there's more constructive activity going on in the stock market? I would argue we want to see fewer stocks getting oversold on these lower lows. The problem for the bulls is that not only are we not seeing fewer stocks showing bearish momentum characteristics, we are actually getting an expansion of stocks showing bearish momentum characteristics. In other words, confirming the downside pressure. Earlier this year, we had the low in January. We had a lower low later that quarter. Fewer stocks getting oversold. That was the improvement of breadth that we were looking for that would say, all systems go, let's buy stocks. And that worked out very well, right? This chart is from March, right? We ripped and made new highs and then failed, as we all know. So this is we've gotten a lot more quantitative, bringing science into, to me, the market is not a science. All these tech guys in Silicon Valley are always trying to turn my art into a science. It's not a science, I don't think. I think it's absolutely an art form, but bringing in the science helps too. I think there was a chess competition recently, and they allowed entries to either be human, machine, or human and machine, right? You could either build a chess player, you could just go in there your own, or you can go in there on your own with a machine. And as it turns out, the best performers were the humans and machines together, right? So I don't think it should be any different in the market. We run all of our analytics. How many percentage of stocks are in uptrends, how many are in downtrends? As you can see, Q1 lows versus fourth quarter lows. We're getting more lows, more stocks getting oversold, right? This is S&P, NASDAQ, and Russell 3000, right? It's a little cut off there. But the point is, not only can we visualize it, but the math itself, we're getting twice as many stocks in the NASDAQ getting oversold. It's horrible. For the bulls, great for the bears. Here, not only here's the percentage of 52-week lows, and here's the Russell 3000. We are nowhere near the first quarter lows, and we are already getting more stocks making new lows. And we're nowhere near those lows in the index. So the internals are actually much worse than the indexes are suggesting. And you probably see it in your portfolios too. You're like, oh, the market's not down that much, but I'm freaking crushed, right? That's a signal in and of itself. So what kind of keeps me in the correction camp versus the crash camp, even though I could not emphasize more that a monster move to the downside is absolutely on the table, is credit spreads, right? All these cryptocurrencies can go to zero tomorrow and it won't matter. All these pod stocks go to zero tomorrow, won't matter. Anybody with money won't care. That's a little kid sandbox. The big boy sandbox is the bond market. It's the biggest market in the world. So if you have hundreds of billions of dollars, you can't play around in these little pot stocks and penny, you can't touch that stuff. You would have to buy the whole thing for it to be worth your while. So the way that they have to allocate assets in the bond market. So if you really want to see what the real money is doing, you have to look at the bond market, particularly credit spreads, right? Shit's about to hit the fan, you're going to see these spreads blowing out. We haven't seen that. They're actually as tight as they've been all year, which is really interesting. We haven't seen that stress, which was another thing in the January correction. Everybody's like, oh, this is the big one, right? But we were looking at credit spreads, and it was super calm, right? No stress whatsoever. So we're still seeing that. So I look at an HYG-TLT ratio, keep it simple, stupid. If you start to see this thing collapsing, that means that credit spreads are blowing out. That means there's a big problem, and that puts crash on the table. So we'll be watching this in the coming weeks. But I think, man, I think it's absolutely a possibility. So for me, as you can see, I showed you the top 40 indexes equally weighted to show what the rest of the world is looking like. Because again, stocks weren't going up the last couple of years because of everything's great in America. Stocks were going up because the stocks all over the world were going up. Part of the extremely bullish thesis that I've had is that the London FTSE 100 is breaking out of an 18-year base to new all-time highs. How can you be bearish when this is on the Mount Rushmore of the most important stock market indexes on earth? Breaking out of an 18-year base. How can we possibly be going too far, too fast, or whatever silly things they say if London hasn't done anything in 20 years? So if we lose this, that's a big, big problem. And we are technically below that. So it's about 7,000. If we're below 7,000 in London FTSE 100, it's a problem. Here we are, 7,100 to be clear. Those are the 2015 highs, and we're down here. That's a big, big problem. That's a lot of room to retest those 2016 lows. Here's London relative to the S&P 500, huge underperformer for a while, making new lows on a relative basis. A lot of downside. Here's the Euro Stock 600, which is essentially the S&P 500 of Europe. Does this look like a massive bottom, or does that look like a massive top? Right? Here's German DAX. Speaking of the Mount Rushmore of stock market indexes in the world, does that look like a massive top, or does that look like a massive bottom? JC, I don't care about Germany. All right, well, if you trade US stocks, you should. Here's the S&P 500, and here's the German DAX. They look exactly the same. Here's France below the 2015 lows. That's a problem, right? So it's not just one. Like, listen, you could punch me in the face once, punch me in the face twice. Eventually, I'm going to get out of the way, right? So when you ripped in 5,000 charts, it's impossible to miss a big theme because you keep seeing the same thing over and over and over again. Here's European banks. If shit's going to hit the fan, European banks are probably going to lead us lower. You don't get market crashes when European banks are breaking out to new 52-week highs, right? They lead us lower. Here we are making new multi-year lows, not breaking out of this monster downtrend like what should have happened if we were going to be bullish this market. The opposite, another oopsie. European banks, if we're below 19 on the EUFN, got to be short, retest those 2016 lows, a lot of downside. Canada not holding the former highs, also breaking down, problem. Australia not holding the former highs, breaking down, problem. New Zealand, oopsie, failed moves, fast moves. Again, it's not one index, it's all of them. The most important stock market indexes in the world. Nikkei, people, when we hit our targets, our price targets, that's a good thing. That's a sign of a healthy market when price targets are achieved. Japan, Mount Rushmore of indexes around the world, did not achieve its target, and in fact, put in another failed breakout, very similar to S&P and Dow. Problem. Hong Kong, double top, also failed at the 2007 highs. Massive failed breakout, leading us lower. Singapore, new 52-week lows. What do we know about new 52-week lows? It's not a characteristic of an uptrend, right? Uptrends don't make 52-week lows. Here's the top 15 developed markets around the world, equally weighted, not above the 2015 highs. That's a problem. Breaking down. China Shanghai Composite, breaking down. Does that look like a massive bottom or a massive top as we are breaking down below those lows? Now, just because the Shanghai Composite is making new lows doesn't mean S&Ps can't go up. Just to be clear, there have been plenty of examples which I have highlighted here where Shanghai is falling and S&Ps are rallying. So just because Shanghai is making new lows in and of itself is not bearish, but the fact that it's breaking down to new multi-year lows and we're seeing all this other crap happening at the same time. So we got to put things in context. India, failed breakout, making new lows. Here's the ETF. Again, this cucumber water, it's delicious. There's the India ETF, Indy, not holding. Former resistance is supposed to turn into support, not when we're in a bear market. Taiwan, Looks like kind of semiconductors, right? Nice consolidation. What do we know about consolidations? That they should resolve in the direction of the underlying trend. Let me emphasize should, because what happens when they don't? There's something wrong. There are overwhelming forces. There are bigger forces at work. This should have resolved higher. It did not. It resolved lower in Taiwan. Big problem. The one thing that's got my head scratching is that Brazil is still pushing up against new highs. You know, you would have told me that all these markets are getting crushed, blah, 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 and Brazil's pushing against new highs. Say no way, right? Just goes to show you, we don't know anything. So that's one interesting thing that I think speaks to perhaps maybe some relative strength in the natural resources, because we're seeing similar relative strength out of Russia, right? So I think that speaks to maybe some outperformance out of energy moving forward, even if shit does hit the fan. The top 15 emerging markets equally weighted, also not able to hold the breakout, right? So we're seeing it. Chinese internet, resistance, resistance, resistance. Is that going to be support? Maybe. But what if it's not? If all of that former resistance can't turn into support, that's a big problem, right? And this was one of the leaders to the upside. Look at 2017, what a beast. And it's gotten absolutely crushed. Lumber futures. JC, I don't care about lumber futures. Well, you should, because it looks like the S&P 500, and we've had divergences before that have led to corrections. So with lumber getting slaughtered, what does that say about the S&P 500? I don't like it. So here's a closer look at lumber. Failed breakout. Couldn't even hold that former support. You know, there's a lot of downside in lumber, which I think speaks to weakness overall and risk appetite. Also, the homies are getting crushed, right? Home builders, ITB, XHB, slaughtered, which we'll get into in a second. So part of again, we don't know what the market's going to do. So last month, I'm like, all right, if the market's going to fall apart, this breakout in the equally weighted retailers index is going to hold if the market's going to go higher. In fact, equally weighted retail index breaking out of a multi-year base to new all-time highs is extremely constructive for the market. Like, this takes out the Amazon effect. So shit, if retail's breaking out of a base, I can't be bearish. But if that breakout fails, that's a big problem, and that's exactly what happened. And the other one I said was aerospace and defense. If aerospace and defense comes out of the 7-8 month base to new all-time highs, hard to be bearish, right? Big part of industrials, leader along the way, got to be bullish. But if the market's going to roll over, we're going to lose retail, and we'll probably lose aerospace and defense, and we've lost them both, essentially confirming everything we're seeing everywhere else. So what I like to do, let's not spill the water, is I like to look at the sectors that are more offensive in nature: technology, consumer discretionary, financials, obviously, and then the more defensive areas: healthcare, utilities, staples, right? Markets going down, staples are going to outperform, et cetera, et cetera. Markets going up, the offensive, the financials, technology, consumer discretionary is going to outperform. So what I do is I take an equally weighted basket of the offensive sectors and an equally weighted basket of the defensive sectors, and I put a ratio. And it really kind of looks like the S&P 500. So here we are making new highs in S&Ps, and we're putting in lower lows, lower highs in the risk on versus risk off sort of thing. And again, it's not one chart. It's not one indicator. It's collectively, the weight of the evidence is really what we're talking about here. So if the market's going down and consumer staples are outperforming on a relative basis, right, we want to watch staples on a relative basis as a heads up of what the market's going to do, because they look the same, right? In this case, I took the S&P 500 as the numerator and staples as the denominator, just so they moves with the S&P. New highs in the S&P, lower highs in the ratio. And it's not just happening at a random level. The relative strength is starting from the same place it started in the fall of 2007, which I don't know if you guys recall. It's kind of a big deal. So if we get above these former highs from the last couple of months in staples relative to S&Ps, and we get a squeeze here, that squeeze is most likely happening when S&Ps are getting clobbered. More relative strength. Healthcare, another defensive area, breaking out on a relative basis. You're seeing that flight to safety underneath the surface, which makes perfect sense. So this is consumer discretionary versus S&Ps, which should be outperforming if the market's going to go up. They're struggling to hold the 2015 highs. If that doesn't hold, there's a lot of downside. There's consumer discretionaries on its own. If we can't hold these levels, a lot of downside. I think the risk reward is very much skewed in favor of the bears. So this whole time that we try to frame like, okay, what's the market going to look like if the market's getting slaughtered? It's like, well, the market's going to get killed. We need a sector that's going to lead us down. And when you look, there hasn't been a sector that you could say that's the one that's leading us lower, which was part of the bullish argument. Now we do have a sector that's leading us lower. Homies are getting absolutely crushed. So we do have that. And if you don't care about homies, you should, because it looks like the S&P 500. New highs in S&Ps, lower highs in the homies is a problem. Materials, 15-year relative lows this week. Financials are not just selling off at a random area, they're selling off near those 2007 highs. One of the few sectors that's not above those 2007 highs yet. I've been in the camp that we were eventually going to break out above this area to new highs, but we have not. So we want to be short banks if we are below that area. Let's call it 29 bucks on the XLF. For above that, I think that would be pretty constructive. Here are regional banks, also underperforming, went out at the lows on Friday. Homies, out at the lows. Those are not the types of things that we see when markets are going up. Those are the types of things we see when the markets are going down. If we lose 54 on regional banks KRE, there's a lot of downside. And I think that's the higher probability outcome. Part of the super bullish case is that you got to be bullish if broker-dealers are breaking out of a 10-year base to new all-time highs. That's not bearish, got to be bullish. If we lose that, that's a big problem. Big, big problem. The argument was if we're going to go higher, tech is going to go higher, semis are going higher, semis are finally going to break out of those March 2000 highs. They did not, they resolved lower. Does this look like a massive top or does it look like a bottom? It could be a mess. I'm going to go with top. I think we break down. So my bet has been that interest rates are going to go up. That has been working, so therefore be bearish bonds. And I still like that strategy, shorting TLT if we're below 116. I still like that. But I got to tell you, if stocks are going to get crushed, bonds are going to catch a bid, flight to safety. But if we're below 116, I still like the treasury bond short. I think rates go to 4%, but like I said, if stocks really start getting hit and we lose 3% on 10s, that's a big problem. That's a flight to safety to bonds. That would be very, very interesting, and it would most likely happen simultaneously with a severe market correction, in my opinion. 3% is what we're looking at. If 10s can't hold 3%, I think it's a problem for stocks. And so, you know, most of us have never seen a bond bear market. You know, I know there's some older gentlemen here. I have personally never seen one, but I hear things. This is just a beautiful uptrend. You know, it goes back further when I was born. That's really when the bond market got going. We're breaking for the first time in decades, you know. So here's the short ETF, TBF, still going higher. Again, we want to be short bonds if rates are above 3% on 10s. Otherwise, all bets are off. I don't know how many trade oats. I like buying smiley faces. I wanted to bring this one because I've seen so many frowny faces. You know, got to have something we could buy, right? I like oats. For above 300 in the oats. I had to look hard to find something that I wanted to buy. I also like precious metals. You know, if market's correcting, market's getting slaughtered, you're going to get a flight to safety to metals. You could buy gold. I like platinum. We're down to the 2008 lows in platinum. I think the risk versus reward is higher. If we're above the 2008 lows, I think we long platinum. The commercial hedgers, smart money, have the largest net long position in platinum ever. So you can fight that if you want. I trust them. I think we keep squeezing. And silver's at a pretty interesting level as well, right? Former resistance turning into support. Platinum does well. Silver's probably going to do okay as well. And the junior gold miners, you know, gold miners in general, that whole theme, you know, these guys have just gotten decimated. I got buddies in Vancouver, like the gold capital of the world, and everyone's broke. Everyone's angry, you know. He's like, everyone's poor, he's telling me. Listen, you know, it serves them right. You know, there's been no reason to own gold at all. It's been in a downtrend, right? But I think now things have changed. I think we could be long. As long as we're above the 2016 lows in the gold miners, I think we could be long all day. And here we're looking at gold miners relative to the S&P 500. Notice how everything's relative, right? It's like, oh my God, look outside, how hazy it is. Yeah, compared to every other day, it's freaking beautiful in San Diego, you know, right? You live in Kansas or Ohio, you're going to come out here and be like, holy shit, this place is beautiful, right? Yesterday, the Uber driver taking me to the airport, he's like, yeah, what a hazy day. I'm like, are you freaking kidding me? This is sick, you know? So everything's relative, right? When things are in bull markets, things are going up, they're not just going up on an absolute basis, they tend to outperform the alternatives, right? So if stocks are making new highs, S&Ps, for example, they're not just making new highs on an absolute basis, they're outperforming gold, they're outperforming bonds, they're outperforming the alternatives. So we always want to compare them. So here, gold miners are starting to outperform from a very logical level where they started to outperform a couple of years ago. So again, not only do we want to be buying gold, we want to be buying gold miners, we want to be buying platinum with the freaking commercial hedgers, but on a relative basis, they look good too, which makes perfect sense. And if you don't think I'm completely full of shit, email me, info@allstarcharts.com, and I'm happy to set you up for like a free month or quarter or something like that. The secret code is, I know, JC, just email us. That's what I got.
Can we do a quick questions for JC? David has some questions for his portfolio.
Yeah, exactly. Organizer's prerogative. JC, I hate lumber. No, that's not my question.
I do too.
Yeah, but
so does the market, apparently.
I always learn a nugget from you every single time, and this one that stuck with me was this idea of relative to the U.S. being, for example, the last man standing. When other markets fail, and it comes to the U.S. as the last man standing, how does time factor in to say that, well, U.S. could be the last man standing, but that gives us enough time that the other international markets finish their cycle? Talk a little bit about that. Or
so that was the bullish case, right? And it's not just global markets, it was financials, it was homies, right? Underperforming first couple of quarters. And you know, I was in Toronto recently, I don't know where the hell I was. I've been in different places. And I'm giving a presentation just like this to, you know, find folks like yourself, and I'm like, okay, this is months ago. It's like, all right, so is this underperformance around the world temporary, and we're going to get rotation back in, which is the bullish case, or is that just a heads up that it's a problem? There was a chart going around a couple months ago that showed I think it was the ACWI, the All Country World Index, total return for the year, broken down by country. And it was like flat down, the whole world, and then this giant stick on the top of US. Like it was literally all America. In fact, America was 120% of the total return of the ACWI. It was, right, because everything else was net down. So this is an amazing chart. I should have put it, my bad. It's out there, you'll find it. And the question was, are we gonna get rotation back like we've been getting over the last couple of years, or is that a heads up that something's wrong? And clearly it was the latter. So that's how I looked at it. You always want to like frame it, like Dr. S was saying, you know, think about the future, what the market's going to look like if we're right. If we were sitting here making new all-time highs in the Dow and S&P and Russell, we would be getting rotation around the rest of the world. That's most likely what we'd be seeing. And it's the opposite. The U.S. is catching down to the rest of the world.
JC, question from JC, another question from Dr. Brett.
Yeah, so just to play off what you were saying about scenario building, I presented some data that suggested when we have a big sell-off, it's happened 29 times, and over a 50-day next period, 22 up, 7 down. JC's presenting some evidence that we are washing out, that we are coming down. So what that leads me to do, this is a great example of thinking in a synthetic way. What that leads me to think of, if we see a bounce over this 50-day or so period that is a feeble bounce, that would indicate that the norms are not coming into play, the buyers can't take control, and that the bigger picture that JC is pointing out could be playing out. And that could give a good risk reward.
Yeah, I'll just leave it at this. I think we're either going to buy stocks back at a higher level, if and when we ultimately do break out above those January highs, and this plays out over time, and in the first quarter or something like that, we break out. I think that's the best case scenario. I think that's the lower probability outcome. I think the higher probability outcome is we buy stocks at a much lower levels, and what we will be looking for to go back to that breadth chart. If you guys email me, by the way, I'll send you the slides. We want to see lower lows, and we want to see an improvement of market breadth. So in other words, lower lows in price on the indexes, and then we want to see the percentages of stocks making new 52-week lows decreasing, the percentages of sectors making new lows decreasing, the percentage of stocks showing bearish momentum characteristics decreasing, right? Showing those bullish divergences. Not only have we not seen that yet, we're seeing the opposite, right? We're getting expansion. We're getting more freaking lows in stocks now, and the indexes aren't even anywhere near the lows. So it's like the market is way worse, in way worse shape than the indexes are suggesting. And I think the indexes will catch up, right? Because the internals are always right. You know, everybody's like, oh, what advanced decline line, listen, percentages of stocks above 200. Everybody has a breadth indicator. You know what the breadth indicator is? Just go through all of them. Look at 3,000 charts. And if there are more good ones than bad ones, market's probably not going lower. And vice versa, right? There's no secret sauce. Just put in the work, which is why I tell you guys, because you're not going to do it. So email me, I do it for you, and I'll tell you what I think. Thanks, guys.
Thank you, JC.